Here is a list of a few of the entry strategies that we can use when we flag divergence. And this is not intended to be a comprehensive list, but just a few ideas that you can keep in mind that you can work with. So once we've confirmed a reversal setup flagged by a divergence, we can then look for an entry point either on the first higher or lower close after the secondary swing point. I'll show you chart examples of all of these, exactly what I mean, in just a minute. We can look for a simple flip of the histogram to the opposite side of the waterline, which is the same as a MACD crossover. We can look for a valid trendline break. We've seen examples of that already. We can look for a moving average crossover on a lower time frame or an indicator confluence of some other type on a lower time frame. So let's look at chart examples of each of these now. Here's one entry strategy you can use with a divergence. We're going to draw a negative divergence pattern here, a swing high on MACD connecting back to a higher swing high, and then concurrently on price we have a swing high connecting back to a lower swing high, and those are resistance lines that are divergent from one another. So we're expecting the market to fall. We're looking for lower prices. One way we can think about jumping into this trade is to wait for the first lower close after confirmation of the secondary swing point. The secondary swing point being this one on MACD. We get the histogram giving us a flip on the other side to a red histogram bar, confirming this bearish crossover. And once we've got the first lower close after that, that lines up really nicely. So this arrow is actually pointing at the wrong candle. It should be this red one right here. But once we've got that lower close after the confirming signal on the divergence pattern, one place you can look at going short is right here. So we see what happened. We had this very sharp bearish candle here. Price came down a bit, jumped right back up again on a gap open. And it tested our entry point, but probably didn't test our stop too much if we placed our stop above this candle here. And you can see subsequently price fulfilled that paradigm, negative divergence, falling prices, go short. So that's one potential entry point on this type of a setup. And conversely, if we were looking at a positive divergence, you might consider the first higher close after confirmation of the secondary swing point. Here's an even simpler strategy for entering on a divergence. First of all, let's draw it. We've got swing points on MACD, and this is actually an example where you see we don't have to have a sloping line to get a divergence. In this case, the line connecting the two swing highs on MACD was almost perfectly horizontal. It was a flat line. But at the same time that was happening, price was putting in higher highs. So we connect those two swing points with a rising resistance line, and we see that they're not necessarily going in opposite directions, but MACD is not going in the same direction as price. So that constitutes a valid divergence. What we then can look at doing as for an entry point is just waiting for that first histogram bar to paint in on the opposite side of the waterline, which happened right here where my cursor is hovering. On a close, you can then get in on the open of the next candle after that. And we can see that was right here. Price came back and tested up to the upside a few times. But what we'd want to do in this case is put a stop above this swing high here, probably in most cases. And certainly this contrarian price action here would not have tested a stop placed up here. So that's a very simple entry strategy. It's not the most sophisticated necessarily, and it's one that you would use if you're interested in getting in fairly quick. But it is useful. It's often quite valid if you have a very strong divergence pattern. So that's one entry strategy you can look at as well. Now we've seen examples of where you can use a trendline break on the same time frame as the divergence to get in. But you can also use a trendline break on the lower time frame to do the same thing. Now this chart example is really cool because it actually gives you complementary divergences on two different time frames happening at the same time. So on the 60-minute chart, we had a swing high on MACD connecting back to a higher swing high, and in fact we had the same thing happening on the histogram even though we didn't draw it. Meanwhile, price was putting in higher highs. So that is a classic negative divergence. If you look at this this swing point high up here, that corresponds to this segment on the 15-minute chart. If we drilled down from here on the 60-minute chart to the 15-minute chart, this is what we would see at the same time. So we had first a break of this common sense trend line. Now price didn't respect it by going down right away, but if we just kind of bided our time and waited patiently for a trendline break, what we would see unfolding is we actually got yet another negative divergence. So we had back-to-back divergences on two different time frames, a negative divergence on the 60-minute and a negative divergence on the 15-minute. So that when price broke this very simple, humble, not terribly spectacular little trend line, it nonetheless gave us an excellent entry point to the short side on this down move, and we can see just intuitively, you can see that the market did fall off pretty nicely relative to the 60-minute chart here subsequently. And we were tested a little bit by an up thrust here, but if our stop was placed above the swing high, again, we would have been in no real danger at any time. So that's how trendline break, even a little wimpy little one like this, can be an effective entry trigger when using two time frames or drilling down to a lower time frame after you've seen a divergence. Here's another strategy. We're putting one time frame, the one in which we get the divergence reading, next to a lower time frame to get an entry trigger using moving averages. Now, I'll just give you a quick preamble. This example actually breaks all the rules we've been talking about so far, because we see on this 4-hour chart, the gold-colored line here, the 200-period EMA, is trending up. So we have an uptrending market. And to get a negative divergence, in this case, it worked quite well. And it was even tradable if you are confident in your abilities and your experience. But we're not advocating trading a negative divergence in an uptrending market. This is just an example to show you how the mechanism does work. But again, we're not specifically advocating that you trade these type of counter trend setups. Regardless, let's look at the divergence signal. First of all, we have a swing high on MACD preceded by a higher swing high. They connect with a falling resistance line connecting tops from above. And at the same time as that happened, price was putting in higher highs. We connect those two to give us a rising resistance line. Those two trend line segments are heading in opposite direction. So if anything, it was reasonable to expect a collapse in price. And actually in this particular case, this is where a counter trend trade might have actually been higher probability than usual, because you can see this physical gap between price and the 200-period moving average. It's relatively huge. Price is just way up in the stratosphere, extremely overbought relative to this 200-period moving average. So if you're ever going to trade a counter trend move like this, this is a good kind of signal to look at. If price is way above this 200-period moving average, it's a higher probability than if we were closer down, like somewhere in this neighborhood, relatively speaking. Anyway, negative divergence. For now, we're not going to trade it because it's counter trend. But just again to show the mechanism, we drill down to the 60-minute chart, and what we're looking for, we have a pair of two moving averages, a purple 10-period moving average and a dashed gray 40-period moving average. The death cross comes when the fast-moving average punches down and through the slower-moving average. And what we want to do is wait for just enough closes to confirm angle and separation starting to open up. So that came around here, and relative to the 4-hour chart, we were kind of in this time frame where my cursor is hovering right now. So you can see what happened. That gave us a pretty good entry signal because our stop placed somewhere in this vicinity here would not have been tested even by this little pullback. And it collapsed quite nicely till we got MACD giving us a bullish crossover concurrent with some congestion down here. And that happened to coincide with price almost reaching the 200-period moving average on the 4-hour chart in this uptrending market. So again, not advocating taking this kind of trade, but again, just to show you how if this was a tradable negative divergence, you'd want to drill down and get this moving average crossover on a lower level time frame. And there's nothing special about this chart selection. You could have tried to do that on a 30, 20, or 15-minute, however you wish. So 2 time frames, moving average crossover, great entry signal. The fifth of our 5 generic entry strategies here is to look for a signal confluence on a lower time frame. So instead of squishing the charts in this example, I'm just going to show 2 back to back. First of all, part A, this is a 60-minute chart. What we're going to do is simply outline the divergence. We've got a swing high on MACD over here connecting back to a slightly higher high. We draw the horizontal trend line segment that connects those 2 tops from above, and we see that this line segment does not end up going in the same direction as the trend line connecting these higher highs on price. A rising resistance line connecting tops from above. So we have now a divergent signal on the 60-minute chart. Let's drill down and see what's going on a lower level time frame. Here is a 15-minute chart. Excuse me, and this price action coming into a new session, this vertical line demarks the start of a new 24-hour period. We can see that a couple things. We had event number 1 was stochastics percent K line penetrated the percent D line above its 80% overbought boundary. That was a bearish signal. We had RSI bouncing south off the 70% line. And we had this indicator here. This is TRIX, which is pretty similar to MACD. I don't actually use this one. I'm just showing you how you can use different signals together. It crossed through its trigger line above its water line, this blue 0 line right in the middle. So 3 different oscillators crossing bearish. Then what we have happening here is we've got parabolic SAR. SAR standing for stop and reversal. It flips from green, which is, these green dots below price action tends to signify that you should be long, and when it flips over to the opposite side, red dots painting in above price, that's pretty similar. It's analogous to a moving average crossover. So we've crossed over green and bullish to red and bearish. So those signals are all giving us the idea to get in short. And finally, we have a 10/40 exponential moving average crossover, a death cross. And by the time we've got all these signals cobbled together, we can easily go short. And you can see what happened here over to the right. Price kind of hugged the central pivot for a while, met numerous hits of resistance against this 200-period gold line, and then just subsequently collapsed beautifully, fulfilling the paradigm on the 60-minute chart. So again, a really nice way you can marry up a setup on a higher time frame and get your precise entry signal on a lower time frame with limited risk and fairly tight stops in this case, and it was a beautiful rundown. That brings us to the end of Module 4, our discussion of divergence. We began this module defining the concept of divergence, MACD and histogram to price. We looked at positive versus negative divergences. We looked at standard versus inverted divergence. And most importantly in all of that is we provided a very simple way to conceive of these divergences. So in other words, instead of getting all hung up about which line goes which direction and what label that gets, we just made note of the fact that when you are drawing lines that connect tops from above, that conveys resistance. And as long as the 2 lines are moving in different directions, price to MACD, it doesn't really matter what you call it, that's inherently bearish. And conversely, when you're drawing support lines connecting bottoms from below, again, it doesn't matter whether standard or inverted. As long as they're going in different directions, MACD to price, that is bullish. So we illustrated the different types of divergence, and then what we did is explained why sometimes divergence has limited effect or no effect, and we gave you a list of strategies, tests actually, that you can use to determine whether the divergence signal is likely to be valid or not. Finally, we gave you just a very simple list of 5 entry strategies, some of them more comprehensive than others. For example, cobbling together 5 or 6 different entry signals on a lower level time frame. That's a little bit more comprehensive than just looking for a histogram flip. But in any event, those 5 different entry strategies do work, I know, because I've used all of them successfully, and I would suggest that you try testing those out in your demo account to see which one that appeals to you the most, or using all of them together, in fact. So that is a wrap for Module 4. Let's move on to Module 5 now.